Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, this is Shiraz Mian, bringing you, as we always do, our top stock picks. Joining me today will be Brian Hayes. Brian manages the income investor and headline trader services for us. So let me get into my stock. The stock I'm featuring today is a small cap infrastructure centric player that I believe is relatively under the radar and most of you haven't heard of. It's Arcosa, ticker ACA, about $3 billion in market cap and a beta that's roughly half of the S&P 500. The shares have had an impressive run this year, up about 22% year to date, which gives you a sense of how good the wind is at its back right now. I've held this stock in the Zacks focus list portfolio over the last couple of years and are sitting on good returns as a result. So Arcosa is, as I mentioned, an infrastructure-centric small player, primarily domestic. So it doesn't have the currency translation issues that you most have been hearing about from the multinationals when their foreign earnings get translated into dollars. Three major lines of businesses for Arcosa. There's the construction products, about 55% of EBITDA, so the highest margin. Then there is engineered products, about 40% of EBITDA, and the remaining is transportation products. Over the last year or so, a little longer, but over the last year, management has been actively working on optimizing the business mix. So exiting what they see as lower growth, lower margin businesses and bulking up the construction products business. Just on surface, you would think that construction, given its exposure to residential and housing, would be more rate sensitive and should be under pressure in an environment where the economy is expected to head down. But Arcosa's construction business, particularly the aggregates part of the construction business, is more than 50% public works. So big leverage to the infrastructure spending that were enacted and that are expected to remain in place over the next few years. So plenty of demand, plenty of pricing power, both at present as well as in the coming periods. Even in the event that the economy goes south. The other half is more related to non-public construction. So a quarter of the total is residential. The other quarter is commercial, non-residential. So there's some exposure. As we know, nobody is exactly recession-proof, but there's plenty of tailwinds for Arcosa that should help it hold its own and continue bringing in the earnings, revenues, and cash flows as the market's reaction thus far to the stock suggests. Beyond construction, the engineered products business, they have a big alternative energy, green energy, renewable energy type of projects there. Some oil and gas as well, and a whole lot of relationships with utilities and generation companies. The wind tower business is a big part of the mix. Demand for wind tower has been somewhat muted lately, but given the new incentives given in the Inflation Reduction Act, through extended and expanded tax credits. The expectation is that 2023 and 2024 should be very good for the wind tower part of Arcosa's business. As I mentioned, they're optimizing the business mix. So they exited the storage tanks business earlier this year. It's a $275 million receipts as a result of that transaction. The expectation is that in the third business, the transportation part of the business, they have railroad and barge related assets and activities, which will likely get exited from too. And the proceeds will go towards bolt-on small scale acquisitions in the construction part of the business. Balance sheet is very strong. Currently, post the storage tanks conclusion, should be about 1.5 times net leverage, which is below management's long-term target of about 2.5 times. So, all in all, an impressive name in the infrastructure space. Not only gives you capital appreciation potential, as I mentioned, the stock's performance this year, but given the low beta, also gives your portfolio plenty of diversification. I'm not suggesting you jump into it and build a position right away. It's not cheap. Currently trading at 10.6 times forward 12-month EBITDA. I'm talking about the EV EBITDA multiple, which the analysts covering the stock typically use for Arcosa and others in the space. Over the last 5 years, the stock has traded as high as 12.5 times, as low as 4.5 times, with a median over the last 5 years of about 9. So at 10.6, it's more towards the high end of that range than the low. But given the positive outlook for the business, the improving mix of businesses, given the optimization, strong balance sheet, I think it's definitely a stock that should be on the very small, close watch list for you. And you build small positions opportunistically. The company's on track to report results later this week, I believe, after the markets close on Wednesday. Given how estimates have been going up and the stock has been responding, it's possible that there's aspects of the quarterly release on Wednesday evening that the market will be less than impressed with and pushes the stock a bit lower, which could be an opportunity to take the first step of dipping your toes in the Arcosa water. All along, I'm recommending Arcosa as a long-term investment that should be a core part of your portfolio for the coming years, not just a tactical trading opportunity. With that, I'll pass it on to Brian Hayes.
Thank you, Shiraz. My top stock pick this week is oil and gas company Murphy USA, ticker symbol MUSA. Murphy is engaged in the marketing and sale of retail motor fuel products and convenience merchandise. The company operates retail stores under the Murphy USA, Murphy Express, and Quick Check brands. Its nearly 1,700 stores are located in the Southeast, Southwest, and Midwest United States. Murphy is a low-cost, high-volume fuel seller whose stations are located near Walmart supercenters. This enables the company to attract significant more transactions than its peers. That's a bit about the company's background and services. Let's shift gears a bit and look at Murphy's industry group. Taking somewhat of a top-down approach here, Murphy is part of the Zacks oil and gas refining and marketing industry, which is currently ranked in the top 4% out of approximately 250 industries. Because it is ranked in the top half of all Zacks ranked industries, we expect this group to outperform over the next 3 to 6 months. This industry has performed very well, up nearly 40% on the year, versus a loss of about 18% for the S&P 500. Quantitative research studies suggest about half of a stock's future price appreciation is due to its industry grouping. In fact, the top 50% of Zacks ranks industries outperforms the bottom 50% by a factor of more than 2 to 1. By targeting stocks contained within leading industry groups, we can dramatically improve our odds of success. Another positive feature to note here, take a look at all these Zacks ranked number 1 and 2 stocks within this group. A large number of highly ranked stocks within an industry serves as yet another confirmation signal that this group is a place to be, as many stocks are experiencing positive earnings estimate revisions, which lie at the heart of the Zacks rank and are the most powerful force impacting stock prices. Also note the favorable characteristics for this industry group. The industry is relatively undervalued and has above average projected and historical earnings growth. Moving along to our snapshot page here, Murphy is a Zacks ranked number 1 strong buy, and the company is ranked favorably by our Zacks style score categories with the highest possible A rating for our growth style score and an overall A VGM score. Just last week, the company reported Q3 EPS of $9.28 a share, which was an 18.67% surprise over the $7.82 consensus estimate. Murphy has delivered a 50.95% average earnings surprise over the last 4 quarters. So they've been consistently beating earnings estimates, and the stock price is reflecting this. And look at how well the stock has weathered the bear market this year. Murphy is up more than 60% on the year and recently broke out to 52-week highs. Only stocks in very powerful uptrends are able to make this type of move while the major indices remain in a deep correction. Analysts covering this company are mainly in agreement in terms of earnings revisions and have been raising estimates across the board. The full year EPS estimates have been increased by 19.73% in the past 60 days. The 2022 Zacks consensus EPS estimate now stands at $25.61 a share, reflecting potential growth of 71.62% relative to last year. Revenues are projected to climb 35.41%. These are exactly the types of trends we want to look for when narrowing down our list of potential stocks. So it's obvious the growth is there and looks set to continue. So Murphy USA, ticker symbol MUSA, is my top stock pick of the week. Make sure you subscribe to get all of our top stock picks. We bring them to you here each and every week on Zacks.com. From Shiraz and I and everyone here at Zacks, thank you for watching. Tune in next week for more of our top stock picks.